1. Start with energy. Explain with authority. Highlight with emphasis and with warmth. The current trading price for SMX Security Matters PLC stands at a staggering $331.98 USD, representing an explosive intraday gain of plus 190.98 or a 135.45% surge as of the market close on December 5th. In the after-hour session, gravity has begun to take hold, with the stock pulling back sharply to 255.08 USD, a decline of 76.90 or 23.16%. When you see a stock with a three-digit price tag moving like a penny stock, doubling in a day and crashing 20% after the bell, your expectation is likely that this is some high-flying tech darling or a biotech firm with a cure for cancer. You expect a company with robust earnings, a stable balance sheet, and a clear path to dominance to command a price over $300. The reality is that you are looking at one of the most engineered, volatile, and dangerous charts in the entire market. The reality is that this price is not the result of value creation, but of value destruction, followed by a mathematical squeeze. SMX has undergone multiple reverse stock splits, including a recent 1-for-8 consolidation, which have compressed the share count so drastically that the float, the number of shares available to trade, has become microscopic. You are not trading a company, you are trading a supply squeeze in a vacuum. The 135% gain today is what happens when a sudden rush of demand, fueled by news of a $111 million funding agreement, tries to fit through a door the size of a keyhole. To understand why a stock that was effectively a penny stock is now trading at 331 USD, we have to dissect the expectation versus reality of the reverse split mechanism. The expectation for most novice investors, perhaps those just starting their self-investing path on the Robinhood app or setting up their first Fidelity brokerage account, is that a high stock price equals a premium company. They see $331 and think safety, comparing it to names like Microsoft or Tesla stock. The reality is that SMX has artificially manufactured this price level to remain compliant with NASDAQ listing rules. By merging shares repeatedly, 1 for 75, then 1 for 8, and so on, they have reduced the number of slices of the pizza, but the pizza itself has not gotten any bigger. In fact, it has likely gotten smaller due to cash burn. This creates a scenario where the stock is optically expensive, but fundamentally distressed. However, this same mechanism creates the conditions for the violence we saw today. With only roughly 1 million shares outstanding, it takes very little buying pressure to send the stock vertical. If a hedge fund or a group of retail traders decides to buy 50,000 shares, that might be 5% of the entire company changing hands in minutes. This low liquidity is the jet fuel for the rally. Let's look at the catalyst that lit the fuse today. The expectation was that SMX was running out of cash, a common fate for microcap science project companies. The reality hit the wires in the form of a reported $111.5 million equity purchase agreement. For a company with a market cap that was essentially microscopic prior to this run, a 9-figure funding line sounds like salvation. It signals to the market that the lights will stay on. This news forced short sellers who were betting on bankruptcy or delisting to cover their positions immediately. And because the float is so small, there were no shares for them to buy. They had to bid the price up and up and up, creating a classic short squeeze feedback loop. This is why you see a 135% move. It is not because the company became twice as valuable overnight. It is because the sellers ran out of ammo. However, we must apply a critical lens to this funding. In the world of small-cap financing, not all money is equal. The expectation is that this $111 million is cash in the bank ready to be spent on growth. The reality often is that these are equity lines of credit. This means the company has the right to sell stock to the investor over time, usually at a discount to the market price. While it provides liquidity, it also guarantees future dilution. Every time they draw on this line, they print new shares, increasing the supply and dampening the price. This is the hidden cost of survival. For investors using Schwab Intelligent Portfolios or looking for long-term investment help, this structure is a major red flag. It turns the stock into a melting ice cube. You are buying a share of a company that is actively printing more shares to pay its bills. The drop in the after-hour session suggests that the smart money knows this. They played the squeeze during the day and they dumped their shares to the greater fool before the market closed, anticipating that the dilution machine would turn on soon. Now, let's talk about the business itself, because underneath the financial engineering, there is an actual technology here. SMX specializes in molecular marking. The expectation is that supply chains are secure and that the gold or plastic you buy is genuine. The reality is that global supply chains are opaque, dirty, and full of counterfeits. SMX's technology involves embedding a molecular marker into raw materials, like gold, steel, or plastic, that acts as a unique fingerprint. This marker survives melting, molding, and recycling. You can take a piece of plastic, melt it down, turn it into a shoe, and the SMX scanner can still tell you exactly where that plastic came from. This is the proof economy narrative they're selling. It's a compelling story, especially in a world obsessed with ESG, environmental, social, and governance compliance. If Apple stock investors want to know if the recycled aluminum in their iPhone is ethically sourced, SMX claims to have the answer. The recent news that they are successfully marking gold bars and verifying them through the refining process is a legitimate technical milestone. It proves the science works. The question remains, can they sell it at scale? The disconnect here is between the science and the sales. The expectation is that if you build a better mousetrap, the world will beat a path to your door. The reality is that industrial adoption is agonizingly slow. Mining companies and refiners are conservative. They don't change their processes overnight. SMX has been announcing pilots and partnerships for years, but the revenue has been slow to follow. This is why the stock chart, adjusted for splits, looks like a ski slope from left to right. They have consumed capital faster than they have generated sales. Today's price action assumes that the $111 million will finally be the bridge to commercialization. It assumes that this time is different. For the active trader using SoFi investing or interactive broker trading platforms, this stock is a candlestick battleground. You are not investing in the long-term cash flows of molecular markers. You are trading the psychology of the float. The technical levels on a stock like this are almost meaningless because the volatility is so high. A support level at 250 can vanish in seconds. Instead, you have to watch the volume. The volume today was explosive. This indicates that a new set of holders has entered the stock. These new holders have a cost basis in the 200s and 300s. They will defend these levels initially, but if the price breaks below 200, panic will set in. The bag holder psychology is powerful here. If you bought at 400, the high of the day, you're already down significantly. Do you hold and hope, or do you sell and realize the loss? I want you to pause and check your own pulse on this. If you are holding SMX, did you buy it because you researched the molecular marking efficacy or because you saw it on the top gainers list? Comment below how many shares of SMX you managed to grab or get stuck with during this frenzy. It's a safe space to admit if you were chasing the momentum. We've all been there. We also need to consider the broader market environment. We are in a risk-on period where speculative capital is rotating out of bored, large-cap staples and into high-beta movers. When NVIDIA stock or Tesla stock consolidates, traders get bored. They take their profits and look for action. SMX provided the action today. This is the hot money phenomenon. It flows in instantly and flows out just as fast. For those managing their own Fidelity IRAs or engaging in self-investing, it is crucial to recognize the difference between a core holding and a casino chip. SMX is currently a casino chip. The underlying business is irrelevant to the price action in the short term. Only the liquidity matters. Let's discuss the risks of regulatory fatigue. SMX has received deficiency notices from NASDAQ in the past regarding its share price and market cap. The reverse splits are a cure for the share price, but they don't fix the market cap issue permanently if the stock keeps dropping. The expectation is that the listing is safe now that the price is over $300. The reality is that NASDAQ also has rules about public float and the number of shareholders. If they have too few shareholders,